All right, Candle Range Theory Trader back with you on another video, just talking about fair value gaps and why they will make you profitable. Five um, reasons specifically, so let's get into them. Okay, so I'm not gonna waste time. Let's go. Number one, they're gonna give confirmation of the daily trend of the day. All right, this is the ideal chart that you want to see for a long trending day. Okay, you have a set low, and then you see a fair value gap after fair value gap after fair value gap, and they are just holding. Okay, they'll poke to it and then keep right on going. Okay, we want to avoid choppy days or choppy price action like you see up here at the top where it's up and it's down and it's up and it's down and just consolidating. No, we don't like this type of price action. We like this type of price action, a nice clean uptrend with fair value gaps that manage to hold as time goes on instead of a value gap appearing and then getting taken out, then appearing again, then taken out. We don't like to see that. We like to see them steady, holding, and that keeps us in the trade. You want to be concerned if you see a fair value gap, you got a good feeling on it, and then it disappears because the candle closed below it. So this is just gives confirmation that you're in the right direction for the day. Number two, they can provide tight stop losses. So this is the same chart. This is New Zealand pound on a 5 minute chart. All of these charts are 5 minutes. This one was 5 minutes, and so is this one. All right, so you notice here, low of the day being down here, which we also call our money candle, and price did break above it on the very next candle. And then when the fair value gap appeared, which is right here, ideally our stop loss wants to be either below the fair value gap or below the low of the day. It depends on how far apart they are from each other. But this one right here, just for example, if you would have put your stop loss right below the fair value gap, that would have given you a 10 pip stop loss. All right. And if your take profit was at the Asia high of the day or Asian session high, that would have been a 1 to 6. Okay. So you could have risked, say, 100 and made $600 on this trade right here. Now, do I preach 1 to 6 though? No, I preach 1 to 2, 1 to 3 max. You'll do fine with 1 to 2. But my point is that if you just start with a 1R, and then you can also scale into your position sometimes when it comes to seeing more fair value gaps like this one here or this one right here, you can still start with a 1 to 2, say down here, and still end up adding more to your profit potential as if the margin allows. Because if you're using fair value gaps, they'll definitely help you identify points of interest. And again, that trend is just being solidified as long as they hold. Okay, so that's the main thing. But on the initial entry, they do give the best stop losses, and the same for scale ins. If this fair value gap holds and you want to add a position, say right here, as long as this gap is holding, then your second entry is good as well. So that's something else to keep in mind. Number three, they can give extra confirmation after the money candle break. Now, how I used to teach, and it's still a valid method. It can work because I made money off of it. Is that once you see the money candle break, okay, below the low of the day, or rather below the prior low of the day. This one was a little bit different. But however, if you see a low of the day money candle here and price closes above it, that could be the signal to enter. So if you took an entry right here after this money candle broke, okay, without a fair value gap. This fair value gap here is a red one, which means the trend is short. All right, but if you took an entry right here just based on this price action, let's take a look at how it turned out. Price eventually shows you a little bit of profit before coming back down. I switched the slide accidentally. Sorry about that. But you see, we got a fake bottom, a fake bottom, a fake bottom, and then the price just came up a little bit and then tanked during the USA session. So that's what we don't want to see. But have we waited for a fair value gap on the green side, just to contrast that right here, you want to see a green fair value gap if you're long, all right, then that would give you extra confirmation that you have the money candle breakout, a break above that candle that makes the low of the day, and also a fair value gap. Okay, that's what gets you into the trade. Those are the only two signals I look for to go ahead and enter. Once I see that, I'm in, no questions asked. All right, so because this was the result. So if you take close above the money candle, you can still win. It's just your odds are a little bit higher by waiting on a fair value gap, and you also get a tighter stop loss by default. So next reason number four, fair value gaps offer zones for exiting as price is often drawn to them. Now, is this 100% though? No, it's not. However, while you can aim for 1 to 2 or 1 to 3, if you're the type of person who doesn't mind holding a little bit longer, or maybe you're not able to look at the charts as much, you can use prior fair value gaps as a magnet for price, because we have to remember that price is either moving to a new high or low, or it's filling a fair value gap. It's only moving in one of two directions. So it's either making a new low, and you see here, see this fair value gap, and then it made a new low. Fair value gap, made a new low. Retraced a little bit, made a new low. But now here we have a fair value gap to the upside right here. So if it's not going to make any more lows, then where do we expect price to go? Let's take a look. All these targets that I just picked are gone now because they've been filled, and that's why they disappear. So this fair value gap, the one that was pointing here, and the one that was pointing here has all been filled by this rising price action. So you can use this as a guide to say, okay, well, I think or I believe that price may start to fill these gaps if the trend is strong enough. So you're basically just looking for that reversal of the trend, more or less, or if nothing else, a retrace, whereby first price was gapping, but no fair value gap is going to last forever. Eventually, it does need to get filled. In this case, that is what happened. So you have gaps to the downside, and they are filled by momentum to the upside. And then eventually, all these gaps are going to be filled too, but it's just a matter of when, not if. All right. But again, those gaps that are unfilled can be magnets for price. But this you don't really necessarily need. I still stick with a 1 to 2, but I do like seeing gaps like this if I'm long, and I just know, okay, well, this gap right here pretty much would give me my 1 to 2 or 1 to 3. So I can see once this gap up here fills, then I'm good to go. As long as these gaps start appearing, I'm expecting these gaps, these red gaps to disappear as green gaps come up more and more. And same vice versa. If you have a bunch of green gaps, and then a red gap starts appearing, you're expecting, the green to take out the red and vice versa. All right, so that's that. And then the last reason is that fair value gaps can increase your win rate when you get the daily bias right. Fair value gaps work the best when you are in line with the trend of the day. I'm not talking about the overall market trend or price has been trending for the last 8 weeks. I'm not talking about that. Our only goal as candle range theory traders is to catch the daily trend. I don't care what the trend is doing 2 weeks ago. I don't really care what the trend is going to do tomorrow. I only care about today. So if you can master the daily bias, okay, which way you expect price to go, you can spot the money candle above or below the prior day's high or low. If you can enter on the first fair value gap that gets created, it's possible to win 75 to 80% of your trades. Okay, that's a reasonable win rate that you could expect. All right, here's how something like that would look. So once again, just going through the basic steps. This is a daily chart. So we're looking at this candle right here. This is a Thursday candle. So because it's a green candle, we are expecting a short. So what we're going to wait for is a money candle above this prior day high right here. Okay, we're going to wait for price to go above that on the 5-minute chart, create a red fair value gap, and then that's going to be our entry. And I pretty much like to, you can start. While I start in London, you can start looking for these setups as early as about midnight to 1 a.m. if you Eastern Standard Time, if you're so inclined to stay up that late. Okay, so this is how it looked. Okay, this was the prior day high of Thursday. All through Asia, this is always a good sign. If you see most of Asia above the prior day high, that's a good sign that it's going to get ready to reverse most of the day as Asia ends and London begins. So as you can see here, the money candle was created at 12:10 a.m. The price did break below it. Okay, right here, this is this blue line. So this candle created the high of the day, closed below it. That's the first step. And then sometimes they'll occur in rapid succession, and you just have to be ready for that. Because once I see this fair value gap confirmed, if I get a break of the money candle and a red fair value gap at the high of the day, that's all I need to see. And it's in line with my daily bias. That is all I need to see, and I'm in. I'm in. No questions asked. Okay. And my signal to exit will be if this fair value gap closes. So I don't even though I have my stop loss can be above the fair value gap, I just set a price alert. And if I see price close above the fair value gap, I don't wait to get stopped out. I'll take myself out because 9 times out of 10, it's just going to keep going and stop you out eventually and make a new high of the day. Because remember, if it's not moving towards a fair value gap, it's moving towards a new high or low. And in this case, we have red fair value gap and then another one being created. And again, the trend is confirmed because price action is showing that fair value gaps are holding. And even though it may wick through it right here, see how price just kept right on tanking right here. So this would have been good for a 1 to 3. But of course, it did go for much farther than that. That's clearly evidenced by what you see here on the chart. But just the low of Asia is fine. Like I said, you don't have to catch the whole move to make a lot of money. And this is the day. Okay, so this is the day when it finished up. All right, so first this day here led to this day right here. Okay, but your entry was somewhere, up here, based on the daily bias of, red because the prior candle was green. So you just want to take the opposite side of it. So in conclusion, fair value gaps can be a great cool tool to support the candle range theory. Okay, we're still on that. We're not abandoning that. Candle range theory is just how we understand market structure, meaning that, and I'll use this as an example, if this candle is the high and this candle is the low, then once price goes above the high, I'm just looking for a false breakout. That's all. So I'm not trying to go long up here. I'm trying to go short. And for a candle low, I'm not trying to go long down here. I'm sorry, I'm not trying to go short once the low breaks. I'm looking for a long in line with everything else that I've taught on this channel. So fair value gaps give extra confirmation of what you believe you're seeing. So if you believe that the daily trend is short, you want to keep looking for those fair value gaps, the red ones, to appear. If you believe the daily trend is long, you want to keep looking for those green fair value gaps, and they should hold. Once again, they should hold. The non-negotiable is the very first one. This one right here, the top one. That should hold. If this top one gets taken out, I would go ahead and just exit the trade. Okay. But as more appear, you want to see them hold. Okay. These hold. This one held. This one held. This one held. This one held. We'd love to see it. And if they're all the same color, even better. All reds. This one isn't. But, like I said, if they're all the same color here, that can also be a good sign. And the same for longs as well. Not to beat a dead horse, but right here, okay, holds, 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 all of them. They should hold. So that's just confirmation for you. Okay, so lastly, you want to be unemotional about these things. Okay, you're not placing all your faith in just one fair value gap and think you're going to be able to quit your job just because you've mastered the fact that you see a fair value gap and now you just take it every time you see one. You have to put them in the right context of the market, and do not give the fair value gap a second chance once price closes above it or below it, depending on the color of it. So if it's a red fair value gap and a green candle closes above it, get out of the trade. When I do this, it has saved me so much money, because do I like taking a loss? No. But what do I like more is being able to trade again. I'd rather take a $30 loss and then win $100, $150, $200 instead of taking a $200 loss and then I have to make another deposit or try to get some money to start all over at the end of the day. That you're going to do one or the other. You're going to keep refilling your account with deposits, or you're going to be disciplined enough to be very rigorous and regimented in your trading, whereby all you're doing is making withdrawals. But it's up to you. Me, I've decided to make withdrawals, not deposits. So that's what I do. That's what I've been doing, and I teach people to do the same. So if you do this, it can protect your downside, and it will let you trade again if you understand that your signal to exit the trade is if the fair value gap fails in your direction. So just to reiterate that, this gap right here, if you're short, if it fails, you get out. This gap right here, this lowest one, if this gap fails, if a red candle comes all the way back down and takes it out, chances are it's going to take this low out too. Okay, so this gives you extra time, and it gives you just a way to get out earlier than just waiting to get stopped out. Protect your downside and just wait for the next level of strike zone and you strike again. All right, so I definitely appreciate your time and attention. Thank you so much for watching. Don't forget to like and subscribe to this channel for more trading and tips, and have a great rest of your day. Take care.